Accounting policies.
Accounting policies are the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. Selection and application of accounting policies. When a standard or an interpretation specifically applies to a transaction, other event, or convention, the accounting policy or policies applied to that item must be determined by applying the standard or interpretation and considering any relevant implementation guidance issued by the IASB for the standard or interpretation. The standard IFRS or IAS or interpretation IFRIC or SIC that is applicable to the relevant transaction, other event or condition. When an IFRS specifically applies to a transaction, other event or condition, the accounting policy or policies applied to that item shall be determined by applying the IFRS. In the absence of a standard or interpretation that specifically applies to a transaction, other event or condition, management must use its judgment in developing and applying an accounting policy that results in informing that it is relevant and reliable.
When can you change the accounting policy? Only at two circumstances. When it is required by another IFRS. This will be the case when new IFRS is issued and you have to apply it mandatorily. When new accounting policy provides better, more reliable, and relevant information. In this case, you apply new accounting policy voluntarily. Note that the changes in accounting policies do not include applying an accounting policy to a kind of transaction or event that did not occur previously or were immaterial. How can you change the accounting policy? If you apply new IFRS and this IFRS contains some transitional guidance, then you simply follow the rules in the transition provisions. However, if there's no transitional guidance or you change your accounting policy voluntarily, then you should apply it retrospectively. Retrospectively means going back to the previous reporting periods and restating every single component of equity as if the new policy had always been in place. The following are not changes in accounting policies. First, the application of an accounting policy for transactions, other events or conditions that differ in substance from those previously occurring. Second, the application new accounting policy for transactions, other events or conditions that did not occur previously or were immaterial.
Changes in accounting estimates.
Other reporting changes in accounting estimates. In the book Accounting Principle versus Accounting Estimate, it is defined to be an adjustment of the carrying amount of an asset or a liability, or some change in the pattern of periodic consumption of this asset or a liability. Bonded allowance, warranty liability, and depreciation are some of the most commonly known examples under the changes in accounting estimates. According to Bragg, 2022, bonded allowance is a reserve accounts receivable that customers may not pay. Actual bad debts are charged against this allowance account when they are recognized. Then, Bragg also defined warranty liability as a liability account in which a firm records the amount of repair or replacement costs that it anticipates spending for items that have already been shipped or services that have already been rendered. This can be a severe liability to come more complicated things prone to breaking.
Lastly, the depreciation. Bragg stated that it is the intentional, progressive lowering of an asset's reported value during its useful life by charging it to expense.
Now, we proceed to the difference of accounting policy and accounting estimate. An accounting policy is a specific principle, rationale, custom, rule or practice used by entities in preparing and presenting financial statements. An accounting estimate, on the other hand, is an adjustment of the carrying amount or period amount of an asset or liability.
Effects of accounting estimates in business. A change in accounting estimates results from new information or modification to the estimating techniques affecting the carrying amount of assets or liabilities. A change to an accounting estimate should be based on events, facts, or circumstances that occurred during the period in which the estimate was changed. A common example is a change in the method of depreciation applied to fixed assets, which is effectively a change in the estimate of the future benefit or pattern of consumption. In such cases, the effect of the change in accounting principle or the method of applying it may be inseparable from the effect of the change in accounting estimate. Such change should be accounted for as a change in estimate. However, the disclosure for both a change in accounting principle and a change in accounting estimate would be required. A preferability letter is not required for a change in estimate. Affected by a change in accounting principle, other changes in estimate do not require an assessment or preferability.
Errors.
Errors can arise in respect of recognition, measurement, presentation, or disclosure of elements in financial statements. Financial statements do not comply with IFRS if they contain either material errors or immaterial errors made intentionally to achieve particular presentation of an entity's financial position, performance, or cash flows. Potential current period error was discovered in that period was corrected before financial statements are authorized for issue. However, material errors are sometimes not discovered until a subsequent period, and these prior periods are corrected in the comparative information presented in financial statements for that subsequent period.
In addition, when an entity corrects a prior period error in calculating its liability for employees' accumulated sick leave in accordance with IAS 19 employee benefits,
it disregards information about unusually severe influenza season during the next period that became available after financial statement for the prior period were authorized for issue. The fact that significant estimates are frequently required when amending comparative information presented for prior period does not prevent a reliable adjustment or correction of the comparative information.